Hey everybody, Trader Razor here from Conquer Wall Street. It is January the 10th, and I'm thrilled to share my long-term technical analysis of the major stock market indexes, stock sectors, Bitcoin, and a few of our trading systems built for busy investors that work during normal trading hours but want to profit from easy to follow end-of-day trading strategies. Now, I know that some of you might be seasoned investors while others are just starting out. And that's okay. But I just wanted to say, if you have any questions at all about this video, don't hesitate to reach out to my support team at conquerwallstreet.com. We're here to help you navigate this wild world of investing. Remember, this analysis is just one more tool in your toolkit to help you gain insights into the markets. And let's start by dissecting the latest roller coaster ride on Wall Street. A wild Friday that saw stocks take a nosedive on news of an increase in payrolls. I know what you're thinking. I'm confused too, a little bit anyway. This is good news, right? Uh, More jobs are good for the economy. More people with a paycheck, more people working, more people with money in their pocket. That's good news. And you would think stocks would go up, right? Well, that didn't happen. So let's break it down. At the market open, the Dow Jones dropped a whopping 712 points, or about 1.6%. The S&P 500 wasn't that far behind. It shed about 2%, while the NASDAQ composite took a 2% hit on the open. Not exactly the start we were looking for to the year. Well, here's the kicker. U.S. payrolls grew by 256,000 in December. Economists were expecting 155,000. And the unemployment rate dropped to 4.1% when we thought it would stick at 4.2%. So I know you're thinking that's good news, right? More people are back at work. Well, this unexpected job market strength has investors scared about what the Federal Reserve might do next. Traders initially had high hopes that more interest rate cuts would come later in 2025. But after this data, those dreams are fading fast. Look at the FedWatch tool's projections for a rate cut later in the month of January. Odds favor a 97% probability that the rate stays unchanged. And if we jump ahead to the month of March, the odds of an interest rate cut drop to 25%. Instead of cutting rates, the Federal Reserve might just sit tight longer. Remember, they just cut rates in December by a quarter of a point. It's important that we understand why rate cuts are important. When the Federal Reserve cuts rates, it's like giving the economy a shot of espresso in the morning. Loans become cheaper. Consumers get a boost in their spending because they can borrow money for less. Housing becomes more affordable. Fewer consumers default in their loans. And businesses can borrow money cheaper and then reinvest that money back into their business. And then we get more bad news on inflation expectations. The University of Michigan's Consumer Sentiment Index threw another wrench into the works by also missing expectations and raising concerns about inflation. 1-year inflation expectations jumped to 3.3% from 2.8%, with 5-year expectations climbing to the highest level since 2008. So if lower interest rates are beneficial for the economy, and we are unlikely to see any reduction in rates in the near future, it's important to consider that the stock market may have already priced in higher growth expectations. You see, the prospect of maintaining higher rates for an extended period could lead to a correction in the stock market. As of now, the current price to earnings multiple for the S&P 500 stands at 29.55, about 30. To put this into context, it's essential to compare this figure to what a normal historical average would be for the index. Traditionally, the modern era price to earnings multiple average hovers somewhere around 20. What we observe today is a PE ratio that is way above average, and this suggests a strong overvaluation in the market. So, why is this important? The price to earnings ratio essentially means how much investors are willing to pay for each dollar of earnings. An elevated price to earnings ratio suggests high expectations for future growth and profitability. However, history shows us and teaches us that PE ratios have limits to how high they can go. Maintaining a PE ratio significantly above its historical average would necessitate unprecedented and accelerated earnings growth. If inflation remains persistent, the Federal Reserve may have to maintain interest rates at higher levels for an extended period, or even worse, increase rates further. This could ultimately bring stock valuations back to more realistic levels. The volatility index, or VIX, supports this theory. Observing this VIX chart, we see elevated trading levels since August of 2024. In a typical healthy bull market, the VIX trades at low levels, usually in the 12 to 13 range, as seen at the beginning of 2024 in this chart. From January to August, the VIX predominantly remained within the 12 to 13 range. However, as highlighted on the chart, since August of 2024, it has consistently traded between 15 and 28, or rather, even above 28 at certain points back here in August. Clearly, investors and traders are nervous about the investment landscape moving forward. While there's significant volatility in equities, it appears to me that Bitcoin, another volatile asset class, has been trending sideways between 90 to 102,000 in that level. We did get a short break up to 108,000, but for the most part, we've been trading in this range since November. Could the chatter of a Bitcoin strategic reserve be laying the foundation for a short-term floor in the price of Bitcoin? This idea doesn't seem crazy to me. It's a potential reality that could secure Bitcoin's place in the financial world. Imagine this for a minute. If the United States, with its immense economic influence, decided to endorse Bitcoin as a strategic reserve asset through the proposed Bitcoin Act. This legislation, put forward, I think it was by Cynthia Lumens, suggests acquiring 1 million Bitcoins over 5 years. This move would not only enhance Bitcoin's credibility, but also establish a significant demand baseline. The very act of the US government investing in Bitcoin could effectively set a price floor, reduce volatility, reduce supply, and reassure investors and stabilize price fluctuations in Bitcoin. And when we look at the price of Bitcoin, we see a floor of around 91,000. Yeah, Bitcoin currently is below its 50-day moving average, and we do have a little bit of a lower high, but it has held this level at 91,000 since November. Now look at the ratio of Bitcoin to the S&P 500, or the SPY ETF. We see the pullback in the SPY, but the Bitcoin to S&P 500 ratio has gone sideways. Bitcoin has been holding up better than the S&P 500 since December. And we can't say this about many of the other altcoins, which haven't been performing as well as Bitcoin. Now let's move on to the equity charts for the week. First, we present the monthly chart of the SPY, which monitors the performance of the S&P 500 index. This chart includes the 50-month and 200-month moving averages. Most notably on this chart, the SPY has experienced an incredible bull market run since reaching its lows in 2022, when the index retraced to touch the 50-month moving average. In a healthy market environment, periodic corrections are to be expected. Over a longer-term perspective, the chart reveals multiple instances where the index has reverted back to the 50-month moving average. However, since this 2022 pullback, there has been no significant correction, and currently we are considerably extended from the 50-month moving average. If this long-term bull market on the monthly chart is to sustain itself, a pullback to about the 450 price point or the 50-month moving average would be necessitated at some point in time. But this chart looks so extended and so overbought, it's very concerning, especially when we look at all the things we've discussed throughout this video. And this isn't any different when we look at the NASDAQ or the Dow Jones Industrial Average. When we pull up those monthly charts, we see the same significant extension of the price from that 50-month moving average. Next up, the daily chart shows a head and shoulders topping pattern in the SPY ETF. And we have our neckline here, and you see all those touch points. And today on that big down day that we had for the S&P 500, you see it touched that neckline and it bounced off of it slightly. If this neckline breaks, it's conceivable that a measured move would take it down to about the 560 level on the SPY or right around that 200-day moving average. And if it does come down there, it's not unconceivable that we could even see a wick where it takes out all the stops that are below that area and then recovers and comes back up again. And the 200-day acts as support. We shall see, but we do need to hold this neckline to avoid further downside, I believe, in the SPY ETF. That being said, if you've been trading our Trendmaster Pro end of day trading systems, you've done really nicely. Here's the performance of the SPY ETF Trendmaster Pro end of day trading system. This system has an 80% profitable trade history over the last 10 years. And what's really incredible, we see that we initiated a long position for the system on February 24th of 2023 at an approximate price of $395 per share. And during that time, we strategically took profits at 10%, we took more profits at 15%, and we took more profits at 25% gains. This approach has ensured that we have already secured significant gains regardless of any near-term stock market fluctuations. The following chart illustrates the percentage of stocks within the S&P 500 index that are trading above their 200-day moving average. In a healthy market, this ratio typically tends to trend above the 50 level. Dips below the 50 level may indicate potential market corrections as observed in September of 2023. Currently, take notice that we're hovering right here at that 50 level. If it dips below that 50 level, we might see a correction like we saw back in 2022, 2023. Here's a chart illustrating the percentage of stocks trading above their 50-day moving average. When we look at this, we saw this period of consolidation on the chart. And I said weeks ago, whichever way this consolidation pattern breaks, whether it's to the upside or the downside, will predict the next move in equities. And we see we had some divergence up top here. The index kept making higher highs, but then we had this trend line of making lower highs, and then it broke this lower trend line where it was showing a little bit of strength to the downside. And what happened? The price just kind of went sideways, and then eventually the index caught up with this oscillator, and it did a great job of predicting the downside move in the S&P 500. We've been closely monitoring the SPY's weekly chart for several weeks. Pay particular attention to the divergence on the RSI indicator, which we identified as an early signal of potential market decline. We'll be looking for a break above the upper trend line to confirm the conclusion of this downtrend we're currently seeing in the market. And now let's dive into the sector analysis. This week's heat map indicates a shift towards some of 2024's underperforming sectors. Energy was up 2.66%, and healthcare is up 2.08% on the week. We've previously discussed valuations, and it's worth noting that if market participants are expecting prolonged higher interest rates, increased inflation, and continued market volatility, there could be a cautious movement into these undervalued sectors. Although it's only been a week, This trend warrants close monitoring moving forward. And let's see a little bit closer where some of that money has been flowing on a bigger scaled picture outside of just this past 5 days into energy and healthcare. And the first chart up we have is the S&P 500, and we have a ratio at the bottom of the equal weighted S&P 500 versus the S&P 500. And as you know, the SPY ETF is heavily weighted to the Magnificent Seven stocks, the Apple, the Meta, the Google, and 30% plus of the SPY ETF, those Magnificent Seven stocks compose in that exchange traded fund. But when we look at the RSP ETF, it equal weights every holding. So even the smallest of companies within the index has an equal weighting to something like NVIDIA or Meta or Google. And when we look at this chart, we see that the equal weighted has been underperforming the SPY ETF, which tells me a lot of money has been moving into those Magnificent Seven holdings. And we see that here when we took the MAGS ETF, which is the Magnificent Seven exchange traded fund, and we compare that to the S&P 500. Notice how since October, this has just been trending up, up, and up. And that tells us it's been outperforming the S&P 500. That money has been rotating into those Magnificent Seven equities. And they've been doing that in greater proportion than they have in other asset classes like the S&P 500 or the overall stock market. And here we have the mega caps, and those are all mega cap holdings. So when you're talking about the Apples and the Microsofts and the Nvidias, those are all mega cap growth companies. So if we look at the mega cap growth exchange traded fund and compare that to the SPY, we see the same outperformance. And that just tells me what I've been telling you folks for a few weeks now is that money has been rotating into those big cap, mega cap growth names. It's been rotating into Bitcoin, and we're seeing it rotating out of a lot of the interest rate sensitive sectors like utilities and real estate and even consumer staples. But one sector seems to stand out to me quite a bit, and that's gold. If we look at the weekly chart of gold, gold usually goes through these long trending periods, as we see here through 2021 and 2023, and then it breaks out to the upside. But we did, on this breakout here, we had this little bit of consolidation here on the weekly chart. But if we take these pivot highs and we draw a trend line to the downside, we see this week we have a little bit of a breakout to the upside on the gold ETF. Will this continue? I don't know. But when volatility is high and investors get fearful, a lot of times there's a flight to safety to gold. And we need to watch this as an indication of whether or not there might be greater downside in the stock market. And let's go close things up with our Bitcoin and digital currency analysis. As always, I like to start off with the Fear and Greed Index. This is unusual because for weeks now we've been talking about how we've been at the greed and extreme greed level. I believe last week we were at 74, which was just greed. And the week before that, we were sitting somewhere around 78, these high extreme levels of greed. And now this index is very neutral. And I don't know if that's because a lot of investors and traders are thinking that Bitcoin sometimes correlates with the S&P 500 in the overall market. And if there's a lot of fear and coming into the stock markets, that some of that will carry over into digital currencies. I don't know yet at this point. But this is the lowest level I've seen the Fear and Greed Index at in quite some time. Also, one thing we like to look at every week is the coin shares flow by asset. And throughout November and December, we were just seeing ridiculous amounts of money pouring into Bitcoin and pouring into Ethereum. And now in the new year, we're seeing weekly flows coming out of those two digital currencies, not anywhere to the degree that they were pouring in the months of November and December. But it is interesting to note that there is weakness in the flow of assets into these two big mega cap digital currencies for the month of January. However, it is interesting to note that XRP, which was also one of the leading asset classes for flow of funds coming into the asset, is still taking on money in the month of January. Next up, we have the long-term holder supply. which refers to the total amount of Bitcoin held by entities that have held their coins for greater than 155 days. And what we see at the end of this chart is there has been a decline. These long-term holders, when they start unloading their coins, it is usually a pretty good indication of an upcoming market top in Bitcoin anyway. We see this back in 2018. Long-term holders were starting to sell their coins as Bitcoin was going up, up, up. And then what happened? We got a correction and a dip. We see the same thing here in 2021 as Bitcoin was climbing higher and higher. Long-term holders were unloading their digital currencies. And we got a little bit of a pullback and a lot of sideways action. The market kind of topped out there and went sideways. And now, since the new year, the end of December, we're seeing the long-term holders again starting to sell their supply of Bitcoin while the price has been going stagnant around that $91,000 price point that we pointed out earlier. Here we have the spot inflows and outflows for Bitcoin. And we can see that it still looks like the majority of flows is coming out of exchanges, which is bullish long-term for Bitcoin. Here we have the spot Bitcoin ETF flows. And this is a little bit more concerning. It looks like it's a little bit of a mixed picture. I really can't get much of a feel for what's going on with the ETFs. But I would think that investors will be a little bit more cautious with the ETFs because they're not trading 24/7. They're restricted to market trading hours. At least in my time zone, it would be 9:30 in the morning until 4 o'clock in the afternoon. And then if something would happen with digital currencies, you can't sell them overnight. So it would make sense that there would be a little bit more risk off in the exchange traded funds that you wouldn't see on the exchanges. Next up, we have exchange reserves. And this has been declining. There is fewer and fewer Bitcoin on the exchanges. This is a little bit of a delayed chart. This only goes into December, but this looks very bullish long-term for Bitcoin. If I would start seeing Bitcoin coming back onto the exchanges, it would make me a little bit more cautious. The only thing that concerns me right now is the fear and a lot of the bearishness that I see in equities, if that might carry over into Bitcoin. But so far, we've been holding strong around 91,000. I would reassess that opinion if we would break below the 91,000 level. Here we have the weekly chart of Bitcoin paired with the US dollar. Not a whole lot to comment on. We are due for a pullback in this asset. And as I said, this is when you're talking about digital currencies, you always have to price in or factor in the fact that there's a lot of volatility in price swings in these assets. And if you're a long-term holder, you want to be strategic about where you enter. And we see a trend line here going back to October. It is not inconceivable that we get a pullback into this trend line and a bounce from there. It's also not inconceivable that we could get a pullback to this previous all-time high around 74,000. And it's also, if I'm to talk about pullbacks and volatilities, if something would go wrong, it's not inconceivable to see a pullback back to this long-term trend line, which would line up with about $50,000 on the price point. For me, I'm always dollar cost averaging into this asset. And that's just a strategy that I use because I know the long-term picture for Bitcoin is bullish, but I have to be strategic about where it is that I average into my positions. Here we see the cup and handle pattern that formed on a weekly chart for Bitcoin with a breakout. But like I said, and what we showed on the SPY, there is a divergence in the RSI, which really hasn't played out yet. Now, there's two ways to look at this, though. A lot of times when Bitcoin and the RSI gets overbought, you see huge moves to the upside in Bitcoin. So we hit that overbought, but and we did see that big move, but it is still divergent from where we were back in April. And this could be a leading indicator that we're going to get a more significant pullback, which might take us back to one of these levels that we were looking at the previous chart. So please keep that in the back of your mind that there is this big RSI divergence. We even saw that back in 2021 and 22. We saw the price of Bitcoin making higher highs, but the RSI wasn't following that. It was divergent. And what happened back here in 2021? Well, it went from about 70,000 and it pulled all the way back to 20,000. So if you saw that divergence, maybe you wanted to sell a little bit and take a little bit of money off the table, and you could have bought it back at 20,000. Again, not financial advice, but do your due diligence when you are adding to your long-term holdings. Here we have a zoomed in view of the daily chart of Bitcoin, and we see a little bit better picture of that support level we have around 91,000 and that trend line, that intermediate trend line that I showed you going back to September, right on side the chart here. We also see the 50-day moving average is trading above the 200-day moving average, which is bullish for the asset. Onto Ethereum. Here we have the Ethereum spot inflows and outflows. We see money is coming off of the exchanges, which is bullish for the price of Ethereum. Then we have spot Ethereum exchange traded fund flows, and we're seeing money coming out of the ETFs, at least in the short term. And that could be for a lot of the same reasons we saw with Bitcoin. The ETFs do not trade 24 hours a day, and that gives you a greater degree of risk because you cannot move your position whenever you feel like it. Here is Ethereum on the weekly chart, and we see this big giant consolidation pattern. We had these highs up here around almost 5,000. It was actually 48.67. And then we have this lower trend line here, uptrend line. And then we have this area here, what could be a possible double top in around 4,100. We'll have to see, but we are chopping around between that 4,100 level and this 2,800 level, back and forth. We need to see a break above 4,100 to come up and retest these previous all-time highs around 48.67. Here is another zoomed in view of the Ethereum exchange traded fund. Again, the 50-day moving average is above the 200-day moving average. If you traded this mechanical system, we already locked in our first three profits. We got in early and we locked in our first, second, and third profit targets on this. So congratulations if you traded this system. We will keep monitoring it, but it looks like we're getting a little bit of a pullback here in the near term. And that's all I have for you for January the 10th. Hope you all have a blessed weekend. Trader Razor out.